In the towering skyline of Wall Street, power wore a pinstripe suit and pulsed through fiber-optic cables. It didn't shout. It whispered through trades, flickered across monitors, and moved billions with keystrokes. And among the many firms vying for dominance in this fast-paced digital battleground stood Knight Capital Group, a firm that had quietly grown into one of the biggest forces behind the scenes of the American stock market. Founded in 1995, Knight was never a flashy name like Goldman Sachs or Morgan Stanley. It didn't need to be. Instead, it specialized in speed, in precision, in being the invisible hand that made trades flow smoothly for clients ranging from individual investors to billion-dollar hedge funds. By 2012, Knight was handling more than 10% of all U.S. equity trades, moving millions of shares every single day. Its Jersey City headquarters buzzed with the quiet confidence of a company that had carved out its niche and held it with unshakable grip. Over 1,000 employees called Knight home: coders, quants, traders, analysts. Their edge wasn't charm or charisma. It was math. It was speed. And above all, it was technology. Knight's success came from being on the bleeding edge of automation. Long before most of Wall Street trusted computers with real money, Knight was already writing the playbook. Their high-frequency trading systems could scan the market, make decisions, and place orders in fractions of a second. Algorithms, cold, calculated, emotionless, made Knight fast and ruthlessly efficient. The world changed, and Knight kept ahead of it. For nearly 17 years, the firm thrived in a volatile world. When others stumbled during the 2008 financial crisis, Knight managed to stay upright. Its systems were reliable. Its leaders were experienced. Its reputation solid. Investors didn't just trust Knight, they depended on it. But behind every mountain of success lies a blind spot. And Knight, for all its technological prowess and track record, was still run by humans. Humans who, despite the billions they commanded, were just as vulnerable to mistakes as anyone else. And sometimes, when you lean too hard on the things you build, the very tools meant to protect you can become the instruments of your downfall. On the evening of July 31st, 2012, no alarms rang. No storm clouds gathered. The final code updates had been deployed, and the lights inside Knight Capital's servers glowed with readiness for the next trading day. No one knew what those machines would do when the sun rose again. The sky above Jersey City was cloudless on the morning of August 1st, 2012. The Hudson River shimmered as sunlight spilled through the glass windows of Knight Capital's headquarters, where rows of screens lit up like a cockpit ready for takeoff. It was the kind of morning that felt almost too normal. Inside the firm's bustling command center, the energy was steady. No sense of urgency, no red alerts. Traders chatted over their terminals. Programmers double-checked lines of code from the overnight software update, and managers settled into another day of market combat. The NYSE's new retail liquidity program was going live, and Knight Capital had moved swiftly to position itself ahead of the curve. In fact, the previous evening had been unusually productive. The tech team worked past dinner, deploying a new algorithm meant to optimize participation in the NYSE's program. It was clean, tested, approved. The launch window was short, and Knight had a reputation for being first. The firm had even adjusted all 8 of its trading servers. Or so they thought. No one noticed that one server hadn't received the final sweep. One server, quietly humming under its cool blue casing, still carried a legacy function. A test script written long ago, left dormant, never meant to be reawakened. As the clock neared 9:30 a.m., the mood was one of confident expectation. In financial markets, milliseconds matter, and Knight was built for speed. The moment the opening bell rang, Knight's systems would kick in, executing orders across hundreds of stocks within seconds. The bell tolled. Almost instantly, orders began to fly through Knight's systems. Numbers danced, stocks ticked, algorithms engaged, but then subtle distortions. At first, it was the volume. It was higher than expected, not just higher, wildly out of proportion. Then, the movement in stock prices. Wizard Software, a relatively obscure name, began surging like it was the next tech unicorn. From $3.50 to over $14, all in a blink. A trader squinted at his screen. "Did someone punch in the wrong order size?" he asked aloud, trying to hide the crack in his voice. Another looked up from her screen. "Not just Wizard. Look at General Electric. Something's off." They weren't alone. Broker phones began ringing. Other trading firms were seeing bizarre fluctuations. Some small-cap stocks were skyrocketing, others collapsing without explanation. Charts began to look like EKGs in cardiac arrest, and all the arrows pointed back to one place, Knight Capital. In the control room, executives and engineers huddled, eyes scanning lines of live code and real-time market activity. Someone spotted the pattern. Rapid buy orders followed by equally rapid sells, repeated again and again. "Shut it down," one manager barked. "I'm trying," a tech replied, fingers flying across the keyboard. "The system's not responding. Some of these commands are being overridden." By now, the erratic trading was cascading across more than 140 stocks. The firm's own share price began to sink, word spreading like wildfire on trading floors across the country. Knight's algorithm had gone rogue. A storm was now in full swing. But it had only begun. Unbeknownst to those in the room, the algorithm wasn't simply malfunctioning. It was functioning perfectly, just not as anyone intended. And with each passing minute, Knight was hemorrhaging millions. 9:37 a.m. Just 7 minutes after the opening bell, Knight Capital's Jersey City office was no longer calm. It was on fire. Not literally, but in the world of high-frequency trading, numbers moving the wrong way are flames, and by now the screens were blazing red. Prices were swinging in wild arcs. Traders stood behind their chairs, some shouting, others frozen. Phones rang nonstop. A few brokers on the other end were livid, others just confused. But all wanted the same thing, an answer. At the center of it all was a piece of code. The new algorithm that Knight had launched that morning was meant to make the firm money by responding to the NYSE's Retail Liquidity Program, a government-supported initiative to improve price offers for retail investors. It was a strategic move. Other firms had hesitated. Knight jumped in head first. But there was a mistake, a small one, invisible at first. One of Knight's 8 trading servers still had an old dormant software module quietly lingering in its system. It was never meant to be part of the production environment. Internally, they'd once called it PowerPeg, a test program from long ago. Not dangerous on its own, not even active. But when the new code was deployed, it didn't just do its job. It accidentally reactivated PowerPeg. The result? Knight Capital's system had become a runaway machine, buying and selling stock at lightning speed, with no logic, no pause, and no breaks. Millions of trades were being executed. Over and over again, the algorithm was buying high and selling low, creating instant losses, and repeating the cycle as if nothing was wrong. It wasn't just bad trading. It was financial suicide in code form. Thomas Joyce, the company's CEO, had stepped onto the floor by now. He wasn't a man easily rattled. Years in finance had taught him to ride waves of volatility. But this wasn't a wave. It was a vertical drop, a plunge with no bottom in sight. "Get me everything," he ordered sharply. "I want to see the trade logs, the server list, now!" His voice cut through the chaos. Analysts scrambled to trace the problem. Within minutes, they identified the lone server, the one that hadn't been fully updated. It was pushing trades faster than any of the others. That rogue function, PowerPeg, was active. No one had seen it coming. "Shut that server down," Joyce said. But by now, it was too late. The damage wasn't just running. It was accelerating. Knight had amassed billions in unwanted positions across nearly 150 different stocks. Blue-chip names, penny stocks, everything. They tried to cancel the trades, but the rules were tight. Exchanges only allowed trade reversals for extreme cases, stock moves of more than 30% without cause. Most of Knight's trades stood. By 9:50 a.m., the firm's internal estimates were climbing into 9-digit territory. One executive stared at a screen and muttered the number like it was a ghost. 400 million. That wasn't just a rough estimate. That was the firm's entire quarterly revenue, gone in under 20 minutes. Traders watched helplessly as Knight's own stock price began to nosedive. $10, $8.20, $7.50. Wall Street was watching. Whispers became headlines. "Something's wrong at Knight." "Rogue algorithm." "Software meltdown." The firm's name lit up Twitter feeds, news tickers, and Slack chats across the financial world. In a matter of minutes, confidence in Knight Capital collapsed. Clients pulled their trades. Other firms distanced themselves. The firm that had built a reputation on stability and speed was now being publicly outpaced by its own mistake. Inside the building, Joyce knew this wasn't just a technical glitch anymore. It was a war against time, and the clock was winning. By 9:55 a.m., Knight Capital wasn't just in trouble. It was bleeding out in real time. The numbers were surreal and undeniable. Every single minute, the company was losing approximately $10 million. A fire no one could see was tearing through the company's balance sheet, leaving scorched earth behind. And no amount of firefighting could stop it. Inside the trading floor, tension warped the air. Every second that ticked by on the clock mounted into something heavier. One employee later described it as watching a building collapse in slow motion while trapped inside. The usual Wall Street noise had been replaced with a kind of silent disbelief, the kind that sets in when your world begins to slip through your fingers, and there's absolutely nothing you can do. They had identified the rogue server. They had tried to kill it. But the trades were already out. Thousands of them, flooding the New York Stock Exchange like a rogue tide. Knight wasn't just trading fast. It was accumulating positions it didn't want across hundreds of stocks. Stocks that were now reacting wildly in the open market. Shares of obscure companies shot up inexplicably. Even giants like General Electric twitched. The traders on the other side of Knight's wild orders couldn't believe their luck. They were selling high, buying low, walking away with profits that didn't make sense. Meanwhile, Knight Capital was holding the worst end of every deal. By 10:05 a.m., they were sitting on an accidental stockpile worth over $7 billion, a position they had neither the capital to cover nor the time to unwind. Their risk models weren't built for this. Their systems couldn't process it. Their executives could barely comprehend it. At 10:15 a.m., after nearly 45 minutes of uninterrupted chaos, the final patch was applied. The rogue server was shut down. The storm ended. But the aftermath? It was staggering. Knight's internal risk team ran the numbers. The loss: $440 million. Nearly $500 million. Gone in less than an hour. That figure alone was bigger than the company's entire earnings for the previous year. It was not just a loss. It was a wound so deep it threatened to destroy the company outright. There was no time to mourn. Traders and executives immediately pivoted to emergency triage. The question now wasn't, what happened? It was, can we survive it? The firm had to unload those unwanted stocks before prices collapsed and the damage worsened. Desperate negotiations began with Goldman Sachs, one of the few institutions large enough to buy Knight's massive accidental position. The deal was brutal. Knight would dump the shares at market price, swallowing the full loss. Goldman would take over the burden and profit from stabilizing the positions. It was a move of pure survival. And Knight Capital took it. The hemorrhaging stopped, but the damage was done. By the time the clock struck 11 a.m., the truth had set in. Knight Capital, a $1.5 billion institution, a 17-year veteran of Wall Street, had just been pushed to the edge of extinction by a single piece of code, and the world was starting to take notice. By midday on August 1st, 2012, Wall Street had seen enough. Knight Capital's name was now everywhere, not in glowing headlines about innovation or market leadership, but in shocked news alerts and whispers from trading desks around the country. The firm that once executed millions of trades a day with surgical precision had just been caught in the most public financial freefall in years. On the trading floor, Knight's own employees were glued to the firm's tumbling stock ticker. $10, $8.20, $6.70, $4.10. The descent was brutal. With every passing hour, Knight's market value evaporated, cut in half, then slashed further still. By the end of the day, the company's stock closed down more than 60%, and the bleeding hadn't stopped. By the time the week was out, Knight's shares were worth less than $2, a devastating 85% collapse in value. Once valued at $1.5 billion, the company now teetered on the edge of total market irrelevance. Inside the walls of the company's Jersey City headquarters, the atmosphere was post-apocalyptic. No shouting now, just a stunned silence. What had been built over 17 years, deal by deal, trade by trade, innovation by innovation, had been erased in 45 minutes. Not by scandal, not by fraud, not by criminal intent, but by a single configuration error and a system that was too fast to stop. Knight had never imagined such a scenario. No one had. The firm's capital reserves were shattered. Its credibility, its greatest asset in the world of trading, was crumbling by the minute. And perhaps most devastating of all, clients began to walk away. Big names, TD Ameritrade, Vanguard, other institutional clients. They pulled out not necessarily because they believed Knight had done anything malicious, but because reliability had been replaced with risk. And in the markets, trust is everything. Even as executives scrambled to explain the situation to regulators and the media, internally, the truth was clear. Knight Capital was insolvent. Without a miracle, it wouldn't last the week. That miracle would need to come in the form of cash. Fast. And so, over the course of a desperate, sleepless weekend, Knight's CEO, Thomas Joyce, picked up the phone again and again, calling rivals, calling allies, calling anyone with the liquidity and influence to buy them time. $400 million, he reportedly told one group. We need it now, not in weeks, not even in days, by Monday morning. And Knight wasn't offering a thank you note in return. The only thing left to bargain with was control. By the time the sun rose on Monday, August 6th, a deal had been struck. A consortium of investors, including Getco, Jefferies, and Blackstone, agreed to inject $400 million into Knight in the form of convertible preferred stock. On paper, it was a rescue. In reality, it was a takeover. The terms were clear. In exchange for the money, the new investors would gain a 73% ownership stake in Knight Capital. The company would survive, but not as Knight had known it. The independence, the legacy, the power, all of it had changed hands. For the employees who remained, it was a surreal kind of survival. They had made it to Monday, but everything was different now. Knight still had its desks, it still had its screens, but the soul of the company had been sold to save its life. The Monday morning after the meltdown felt surreal. The company still existed. Phones still rang, Emails still pinged, screens still flashed with stock data and blinking lights. But something fundamental had changed. Knight Capital no longer belonged to Knight Capital. The emergency cash infusion, $400 million, wired in just in time, had come with a steep price. The investors, led by Getco and a handful of major firms, now owned the majority stake. They called the shots, they controlled the board, and they had no intention of keeping Knight as it was. For employees, the first weeks after the crash were a blur of meetings, internal briefings, compliance reviews, and media fallout. Behind closed doors, morale was fractured. People spoke in hushed tones. Some desks sat empty. Others were filled with quiet dread. Thomas Joyce, who had once stood proudly at the helm of one of Wall Street's fastest-moving firms, now spent his days explaining Knight's downfall to analysts, regulators, and the press. In one interview, when asked how this could happen, he paused for a long time before answering. "Technology breaks. It ain't good." The phrase stuck. Not because it was elegant, but because it was honest. Despite efforts to recover public trust, the brand was irreparably damaged. The Knight name, once a badge of cutting-edge trading brilliance, had become synonymous with a spectacular failure. Within months, the new majority owners proposed a full merger. Knight Capital would become part of a new entity, KCG Holdings, alongside Getco. The decision wasn't framed as punishment, it was strategic realignment. But everyone inside the company knew the truth. Knight, as it had been known, was gone. The name disappeared from building signs. Email addresses changed. Business cards were replaced. Press releases made no mention of the algorithm or the 45-minute collapse. But within the industry, no one forgot. What followed for the former Knight team was a kind of quiet exile. Some employees stayed on under the new leadership, hoping to rebuild. Others moved on, carrying lessons that would never leave them. One engineer who had helped write part of the code base said it best during a conference months later. "We were so obsessed with speed, with precision, that we forgot to fear our own tools." Outside of the company, Knight's collapse sparked a wave of debate. Financial institutions began reevaluating their own software deployment protocols, implementing stricter safeguards and kill switches designed to halt trading systems instantly in the event of a malfunction. Regulators at the SEC increased scrutiny of algorithmic trading risk, pushing firms to prove they had control over their own machines. And investors, big and small, saw firsthand how human error could echo through digital systems at terrifying speed. But the markets moved on, as they always do. Stocks rebounded. Other firms rose in Knight's place. The trading algorithms got faster. The networks got smarter. The safeguards got a little stronger. Still, in hushed conversations around Wall Street, Knight's name would occasionally resurface, as a ghost story told among developers and traders. A reminder that in an era when billions can be lost between heartbeats, it only takes one oversight, one forgotten file, one silent bug, to bring an empire down. The story of Knight Capital didn't end with headlines. It didn't end with a merger, a bailout, or even a name change. It ended quietly, in the silence that follows catastrophe, in the spaces where lessons live. By the time Knight was absorbed into KCG Holdings, the financial world had already moved on to new stories, new deals, and newer tech. But those who lived through that hour, whether from inside the company or across the trading floors of Wall Street, would never forget what they saw. A company worth $1.5 billion, with nearly 1,500 employees, fell apart in 45 minutes. No scandal, no market crash, just a forgotten piece of code on one of 8 servers, just a single outdated function, never deleted, accidentally triggered by an otherwise routine software deployment. A bug named PowerPeg. That was all it took. In hindsight, Knight's collapse became more than just a financial fumble. It became a symbol of how fragile power truly is in the digital age. The very tools that had made the company fast, scalable, and dominant became the weapons of its destruction. It wasn't about bad people or criminal intent. It was about trusting a system too much and underestimating complexity. The crash sparked urgent industry-wide discussions about algorithmic risk, human oversight, and kill switches. Regulators drafted new rules. Firms rolled out more rigorous QA processes. Engineers added redundancies. And still, quietly, everyone wondered, could it happen again? The truth? Yes, because the lesson of Knight isn't just about trading. It's about any field where speed outpaces caution, where innovation runs ahead of reflection, where automation operates without human guardrails. Knight Capital's fall teaches us that success does not make you indestructible, that decades of reputation can be erased by a single misstep, that growth without governance is a loaded gun. Thomas Joyce, the man who had led the firm through its greatest highs and darkest hour, faded from public view after the merger. But his words lingered in the industry's collective memory. Technology breaks. It ain't good. Blunt, honest, and entirely true. Today, when traders hit enter, when software updates roll out across servers, when algorithms begin their daily dance across the world's markets, Knight's ghost still hovers. A silent reminder of how easily it can all unravel. Because in business, in code, in life, it only takes a minute to lose everything. And sometimes, just 45.